I get new investors ask me, should I go in as a lump sum or should I drip it in? Or quite frequently. I think if you look historically, in the vast majority of cases, you'd be better putting it all in one go.
Yeah, because the market trends upwards more than it goes down.
Yeah, right. Yeah. But, so I tend to say, look, if you want to drip it in, that's fine. As long as you understand that it's more of a sort of emotional, psychological crush than it is a financial one. Because you'll either wish you put it all in on day one or you'll be glad you didn't. That's binary, right? You'll either be better off or worse off as a result of whichever decision you make. But if it makes you feel better putting it in and dripping it in over time, that's reason enough to do it, I think. Yeah. If it's less likely to lead to regret, lost sleep, then do it. You might be worse off, you might be better off. You can't control that, though.
What people don't realise who pay in every month from their wages is they're lump sum investing. They're not dollar cost averaging. They're putting every bit of money that they've got to invest into the market at once. Nice. So, like people think, I dollar cost average through my wages. No, it's all going in. A drip feed would be, I've got 100K here. Do I slap it in or do I go $1,000 a month? And that's a very different kind of mental joust, isn't it?
Yeah, it is. Yeah. I would say, look, never more than 6 months. Else there's too much opportunity to question it. It's like if you got a lump sum of money, don't put it in over more than 6 months. It's just like,
and the inflation is doing a number on it, right? And stuff.
So just either get it in and just suck it up, which is easy for me to say, but obviously not very easy to do sometimes. Or just say, like, look, I'm going to do it and I'm going to set the payments to go automatically, and I just won't think about it.
And what you said as well about over 30 years, is it really going to matter that the market dropped 2% on one day, one random Tuesday?
Won't.
Yeah, no, you'll look at it and go, oh God, I'm glad I bought then. I wish I put more in. Not that there was. You get your Black Mondays, which are big events, but even those kind of they all fade away on the long timeline.
They do when you look at the map over, look at the chart over a 50-year horizon. Those are minor blips, even though they were horrific at the time.
I think, was it Richard Coffin? Someone on the podcast said that time in the market beats timing the market.
I think he was quoting someone else.
Yeah.
Like a Warren Buffett or something.
Yeah, but the longer you're in the market, it's better than like, let me get the right day. It's better to just be in it from the start of the longer time. Yeah.
And again, it's an understanding of volatility and risk. We tend to think of risk as an all or nothing thing. It just isn't. The biggest risk by far is, I think, again, George mentioned this when he was on the show, is that, you're going to miss out on growth. You're going to be able to live less of a full life because you didn't invest, because you were worried about short-term volatility. Volatility is not risk. They're two entirely different things. Volatility is the price of entry as an investor. You've just got to accept it. You can temper it to a point, but it's working for you.
Yeah, the biggest risk of investing is not investing.
100%.
Yeah.
If you want more information on what to do with a lump sum of cash, we're hosting a completely free webinar with qualified financial advisor and friend of the podcast, Lisa Conway-Hughes. I'm going to leave all of the details below for you so you can get involved if you want. Like I said, it's completely free and you'll find that information in the pinned comment.